Welcome to The Real Math of Business with Alena Bennett, where you plus this podcast equals better decisions. I'm Alena Bennett, speaker, author, and leadership expert. I work with chief executive officers and chief financial officers really to help them create universally investable companies where people serve people and the math just works. This week, I'm chatting to Professor Edward Podolsky, but first, here is my thought-provoking question. Now, this week, it's a bit of a thought-provoking prompt as opposed to a thought-provoking question. It occurred to me that this year marks about 10 years since I left corporate. It kind of got me reflecting about the last 10 years in business, what I've been doing and how I got here. I can hand on heart tell you, honestly, there is no way that when I finished high school, when I finished university, I could have ever thought that I would be running my own business, supporting leaders and companies in the way I do. I am so grateful that I'm here, but I could never have expected it back at the time. In fact, people say, how did you go from there to here? And it's only now that I can talk to the narrative in hindsight that I realise. What actually happened 10 years ago was there was a sliding doors moment in my career where I had two or three actually different options in front of me. And one of the prompts that I found useful then and I find extremely useful by now, I first heard it from a lady called Cara Lowenthal. She's a New York based, and she's a former lawyer, now does women's empowerment type stuff. I'm sure there's a better way to say that. And the prompt is, this is the part where ... And the reason why this came to my mind was not only the reflection that it's been, I've been 10 years in business, but I've also had a couple of clients also at inflection points in their own careers. And I think what can be daunting about any sort of key temporal landmark, sliding door moment, shift in role or responsibility, it's an exciting opportunity, but it can be a little bit daunting about what's on the other side with the unknown. So my thought-provoking prompt for you is, if today, as you're listening to this, was a temporal landmark, if it were a line in the sand, how would you complete the prompt? This is the part where in your story. See how you go. Can't wait to hear. And now to our chat with Professor Edward Podolsky. Well, it's an absolute pleasure to welcome my guest to the podcast today. Edward Podolsky is a professor of finance and head of finance department at RMIT's School of Economics, Finance and Marketing, and an associate editor for the Australian Journal of Management. He was associate professor at Deakin Business School, where he held leadership roles including Director of Research Finance and HDR Director for the Faculty of Business and Law. Edward's research examines how organisational structures and governance shape a firm's ability to generate value, with a particular focus on the conditions that enable or inhibit corporate innovation. He studies how shareholders influence executive strategic decisions, how managerial behavioural tendencies affect resource allocation, and how organisations can design mechanisms that harness these tendencies to support breakthrough thinking and long-run value creation. His findings have appeared in top journals like the Accounting Review and JFQA and has been featured in many outlets and publications from Bloomberg to Harvard Business Review to ABC Radio National, as well as many others. Thank you so much for being here, Professor Edward Podolsky.
Thank you very much for having me, Alena. Very much looking forward to the discussion.
Me too, from a personal and professional perspective. But we will get to all of that. I'm really curious. I've been having a lot of conversations with clients at the moment around this idea of a corporate money mindset. And, we talk a lot about personal money mindset, but that obviously, by virtue of corporates just being made up of people, manifests itself in a business as well. So, corporate money mindset we also talk about in terms of capital behaviour. And one of the things that, we're talking about is there are certain industries and companies that showcase a certain corporate money mindset. And in particular, those that perceive money to be evil. Think not-for-profits and think of the education sector. So, with that in mind, I would love to know what made you go deep into academia but deep academia with a focus on finance.
Yeah, oh, that's a great question. And I think there's, like for everyone, where we end up, there's a high degree of chance and luck and serendipity that takes us there. I think two things. So early on, I studied law commerce at Monash, and I think I went into law commerce because even at high school, I really enjoyed politics, law, and business. And I remember in grade 12, I was learning Russian and I got really into Russian music and I wanted to organize a concert for one of the Russian pop stars. And I remember actually going through the whole process of trying to figure it out how it would work, getting all the logistics, and in the process, kind of figuring out how tedious elements of it can be, how important financing can be. Long story short, I was actually really good on the operational side, but I didn't have the guts to actually go forward with it. I noticed there's a big chunk of uncertainty. You don't really know what the outcomes are. So I kind of realized then that maybe entrepreneurship isn't for me because although I love elements of it, I'm not really don't necessarily have the guts always to take the risk. And I had family members that were willing to kind of um, give me some of the money. So I kind of realized going into university that probably entrepreneurship isn't it. So I was thinking investment banking, consulting, kind of exactly down my alley. And for the first 4 years of my studies, that was exactly where I was heading until I did honors, which I did honors because that was kind of the route. You kind of do law, commerce,
Mm.
do honors, and then you go into investment banking. But the problem was that honors is mostly a uh, research year. And then I realized that research is extremely fun. Only then do you kind of realize there's all these really complex conceptual frameworks that help you think about all these complex outcomes. None of those conceptual frameworks actually work in practice. So there's always this kind of tension and debate about which framework works a little bit better, which one works a little bit less. There's a scientific method behind it all where you're always using data to validate some of these different competing theoretical approaches. Um, and ultimately, when push comes to shove, it's a area where we embrace and understand the fact that we know very little, and we're just trying to kind of understand something to the best of our abilities. And that really resonated with me. I think I'm actually more of a slow but deep thinker. I'm really comfortable in an uncertain, at least conceptually, an uncertain environment. I love the exploration process more so than even sometimes the efficiency element of trying to just get the last kind of 1% or 2%. So just like that, without kind of engineering the outcome, I just found that's, what I love. I want to do a PhD. And once you do a PhD, you're kind of locked in. So, so then you don't, there's no going out and you kind of just have a scholarly career ahead of you. So yeah, in short, that's kind of how I ended as an academic in finance. Um, and yeah, I mean, we can kind of drill deeper into the whole money element. I think money, just like maths, etc., that's more of a proxy for more important things. And from my perspective, I have the luxury of sitting in my ivory tower and being able to think about the bigger ideas. But it's really value that we're all kind of interested in, and value has a lot of different sources. It manifests itself in different ways. And money is one way that, for simplicity, we gravitate to, but it's one of many metrics. And like all metrics, it has its own limitations. And there is a risk of putting too much premium and also putting too much emphasis on it.
I love that you went straight like miles high because I wasn't
Sorry.
expecting we'd go there, but I'm so glad you did. And I want to pick up on the very last thing that you said. Money is a proxy, and I think we forget that, right? But you said, money is a proxy for value for its simplicity, but sometimes we place too high of a premium on that. From your deep research and expertise perspective, can you flesh out that idea? Because the layperson like me and many of those watching this, we read all of the books, money is just one of, The Wealth Money Can't Buy by Robin Sharma, the latest one, eight measures of value. Everyone is measured, it's not just the money, it's your personal health, it's your growth, it's your well-being, it's your relationships, so the layperson knows. But when the rubber hits the road, why do we default to the simplicity of money? And why do we place a higher premium on money from someone who knows this at a very deep level?
Well, I think you kind of hit the nail on the head in the sense it's the simplicity. And there's nothing wrong with it. So just to be very clear, there are so many dimensions of value. And some of those are kind of we can structure in the context of corporations. And we can kind of delve deeper into it because obviously a company, an economy, whatever, we're in the business of creating value. So we have a finite amount of resources, and we're really just, putting those resources, human, land, capital, technology, we're putting all of that together to create something that's worth more to us subjectively. I mean, there is a subjective element to everything around it, right? So, and then we can take it even further and talk about, spiritual elements of our life, health, et cetera, and all the things that we can't kind of actually quantify, and those generally are used as the examples of kind of externalities that we don't capture in traditional models. So it's easy to critique it, and this is kind of what I mean. There's so much we don't know. It's almost so easy to default to saying, well, this doesn't work well. But I mean, money is a proxy. It's the value we assign to money is itself a reflection of some of those subjective aspects that reflect our value system, or at least in aggregate. So that's a starting point. And over history, we've had different forms of money, right? So different points in time, salt, gold, there were different kind of things that
Yes.
were the basis of exchange. But we always need something that we can agree on that will allow us to trade, that will allow us to, in a social context, come together and engage in economic transactions where at the end of the day, doing so creates value. So I don't think there's anything wrong with gravitating to money. It's a proxy. It's a very powerful proxy that allows us to keep track of, and to quantify value creation, to enable transactions, to really, it's like the glue that keeps everything together. The problem, I think, becomes, and I think it's more problematic when we look at, we go to the second derivative, so to speak. So you have reality, you then
Yep.
kind of have the first derivative of it is the money that tries to proxy for it. And it's an imperfect proxy for what's actually happening in reality. But then we have a whole host of metrics that help us make decisions about money when money itself tracks what's happening in reality, right? And I think that can itself be problematic because we're continuously kind of we're focusing more on the tools, the conceptual tools, and the risk is when we just try to optimize that as opposed to remembering what the underlying rationale of what we're trying to optimize and where the value actually sits.
Mm, mm. I'm so fascinated already. I'm captivated by the things that you're saying. And I'm so engaged with this almost historic view of money and trade and currency that you've just very briefly taken us through. But, and this is like one of the main reasons I wanted to get you on this podcast. I said to Jez, my producer, my amazing producer, I said, you know what's fascinating about all of this, Jez? I said, I hated economics at uni. I hated auditing and accounting and econometrics and anything to do with numbers. Yet here I am hosting a podcast called The Real Math of Business. I'm about to publish the book with the same name. Where did I go wrong at university? So my question to you, and this is really putting your academia hat on, why didn't I get it then? And why did I not get it to the point where I'm really shaming myself here, stop turning up to lectures, stop turning up to tutorials, not doing the readings. Like I was so disengaged in the conversation. Yet I am frothing at this conversation now. And all of this, like this is what really fascinates me. I think we probably share a mutual fascination of the relationship between the economy and business structures and people and reward mechanisms, right? But when I sat there at university, I just thought this was the most boring thing. Where did I go wrong? What was I missing? What was the missing link for me?
Well, I don't think you necessarily went wrong anywhere. Partially it is our job as lecturers to keep students engaged, right? So maybe it's not on you; it's on your lecturers, and I don't want to shame anyone, but part of it is kind of actually contextualizing it. Part of it is actually just part of the journey, I think. So we can come back to this whole idea of trying to get students engaged, contextualizing um, the importance of what the social sciences are, and finance ultimately is part of the social sciences and how fascinating they are.
Can
But
we
it
just,
also,
sorry, I'm just going to pause you right there. That is that's such a Kodak moment in language. Can you just repeat that statement?
well, finance is part of the social sciences, and there's no two ways about it. Just think
Explain
about
that.
it.
Explain that.
Yeah, exactly. So, finance is part of business, right? Well, not only, we can kind of go more abstract, but let's just look at it like that. Finance is part of business, any firm, any organization is a social structure, and therefore how it operates and the laws that govern how decisions are made, how outcomes are driven, are very much driven by the same dynamics that we would look in political sciences, etc. Again, I know your podcast looks very much into leadership, etc. And absolutely, leadership is important, but part of the things that really interest me is, well, are decisions by leaders shaped by the various forces, some of them obvious, but some of them less obvious, more hidden. So in finance, for example, we would say that investors, to a large extent, shape decisions, because if the governance
Mm.
structures work well, leaders are nothing more than cut out figures that all they do is try to push forward the interests of shareholders. Obviously, that's not true. There's an element of truth in it, and we can't dispel that. But just the very fact that it is not true, and we know it from research, yet at the
Mm.
same time, we have governance structures, a whole corporations act, and then informal structures which very much try to drive that outcome. Yet there are so many different forces that drive outcomes. So it is a social science. If we're trying to understand how organizations make decisions, we have to see it as a social science. There's a human element behind every transaction. If you know better than me in academia, but when a company needs to raise money, there's a very strong trust component that underpins that element, right? You can't just do what we teach kind of in the textbook,
Mm.
where you just issue a bond and you kind of the money flows in. And that kind of feeds into this idea of information asymmetry, etc. Long story short, it's a social science, and we have to see it as such. Um, and therefore kind of there's a context that has to be kind of explained in a kind of more training element, but there are very significant tools, and this is it. A
Mm.
university degree ultimately has a finite amount of time, has students who are all at a different level of maturity, at a different state of life in terms of what they're looking for, what their aspirations are, and ultimately I guess we have, we need to convey, those tools in as quick a manner as possible.
Mm.
And it's
Mm.
those tools that can very often kind of hide the essence of why the tool is used. And I think that's
Yeah.
probably what you experienced. There was too much emphasis, or at least the way you perceived it. You saw the tools, but couldn't really see the why. Why
Yeah.
is this important? And that actually is a problem, because later on they can shape someone's mindset if you're really good in just understanding the tool. and all you know is a tool, and then you go into practice and you see the application of the tool, you're not really necessarily questioning that tool, where it's appropriate, where it's not. And that's not necessarily what academia should do. So I
Yeah.
think that we need to be teaching the thinking element, and we need to be articulating to students very, very early on and throughout the whole degree that whole aspect of these are tools, imperfect tools in a really complex system, and social systems are far more complex and hard to describe than natural systems.
Yes. Wow. And that actually it almost brings us back to that sort of three-tiered, well, four if you say tools is the fourth, that four-tiered approach of we've got a reality, money's a proxy for that reality. We drive we measure metrics to drive money, and the tools help us achieve the metrics. So what you've just described there from an education perspective, and I think you're absolutely right, because one of the things that those weird things that stay in your mind. I have this weird thing that's stuck in my mind from one of the accounting courses, and we had to do T accounts and get them into the general ledger, and
Mm.
the whole thing just was so complicated. And then I went out into audit, and I was like, this is simple. Like, why were they giving us these
Yeah.
general ledger made up of 500 different accounts, and actually what really matters is these 20? Or like, why did they make this so complicated? And I think just even going, there's a reality, money's the proxy, the metrics and the tools, like you say, it's that contextual thing that maybe I was missing, the context being the reality, and then understanding the bridge between the reality and the tools.
Well, I would just add, and this kind of ties, and maybe we'll have time to kind of dig into it. One of the parts that I'm most interested in my research is, those how organizations make decisions, but I'm most interested in the innovative,
Yes.
innovation outcomes, innovation, especially radical breakthrough forms of innovation. That's interesting because there's a whole host of paradoxes. And funnily enough, most of the things that drive great success in terms of performance, efficiency, etc., those are the exact opposite that we need to drive breakthrough innovation. Now, I only mention it here because it occurred to me when you were saying about, how also the delivery was structured. Part of it, in academia, we face exactly the same challenges that a lot of companies face. In the sense, the expectation is that we have to convert every concept. So if we have a subject on auditing, it has to be a, 11 to 13 week structure, and we have to
Mm,
break it down into weeks. And that very often itself, and I've experienced that myself when there's a subject I want to teach and there's certain concepts I want to teach, but actually breaking it down into those modules is extremely difficult, and it's a big
mm,
chunk of the challenge of being a good educator.
mm.
But it is a delivery model that students expect, the universities expect, and it's not really kind of a mistake, I think, by universities, because
Yeah.
that's the expectation, that there's
Yes.
accreditation bodies that expect it, etc. But I guess that kind of does highlight there is, like across the board, including in academia, there are questions about, well, what's the most innovative approach where we can convey the idea, right? And there's
Mm,
probably in the natural sciences and in the social sciences and in every different course, in an ideal world, you would package that idea slightly differently, but you kind of have to package it in a given way. And
mm.
sometimes that form of packaging doesn't necessarily translate into the best outcomes. So, and I assume it's exactly the same problems that, every business faces, right?
Yes.
It's this idea of needing to standardize certain elements to make it work. There's a tradition to it, but it can result in the idea being a little bit distorted, right?
So I love that you've talked about that, because one of the things I know, in fact, it was in your bio that you love to understand and delve into the research of how structures and governance work to create value. Now, you talk to most people that work in business and they do not equate structure and governance to value. In fact, they probably see structure and governance as hindrances to value. The way we in our business talk about math is we talk about it actually in those same terms. It is It's money, it's metrics, it's tools, it's structures, it's governance. It's the constraint of business that people need to operate in.
Mm,
And so we kind of say, what we're trying to do is help businesses create businesses where people serve people and the math
mm,
just works, right? So we have this ratio that we just use as a starting point, 50-50, 50
mhm.
people, 50 math. I'm curious from your perspective what that ratio would look like. And because then I'd like to kind of delve into what are the elements that underpin from your research background, and also just like that link between governance structure, value, the mechanisms that create value. I'd love to go there, but if we can start by pinning you down and asking you your real math of business ratio, people to math.
Yeah. Look, as a academic who specializes in, mostly works with quantitative methods, I'm going to be generous to math. And I'm going to put it at 40% math, 60%. 60% people, although I'll kind of, in my mind, it's more kind of quantitative versus qualitative approaches, right? Because I think it can be, um, it's really a matter of how do we approach problems, how do we approach value creation, and what kind of information and processes do we follow. Like I said before, maths is and can only be a tool, right? So it's a really important tool and it's a foundational tool. And I don't think we can or should discount it, right? So maths, the beauty of maths is that it gives us a degree of objectivity and it gives us a degree of discipline. And we could go on a rabbit hole of the all the other kind of benefits of maths, but those are the two main things, and these are the things that we need when we're trying to make a decision in a very noisy, complex, uncertain environment. We need those
Mm,
anchors so that at least we can understand what the underlying trade-offs are, what the different forces shaping the environment are and shaping decisions are,
mm,
etc. And in order to, work through genuine trade-offs, and this is kind of really what economics slash finance is all about, identifying trade-offs and
mm,
working through those, we need, to have some numbers that will allow us to work through it, right? So both in theory, in terms of
yeah,
trying to identify what those different factors are,
yeah,
how they interact together, and therefore to form some kind of conceptual maps around where it's all going. And then
mm,
in terms of actually trying to see in reality, what's happening, we try to quantify things.
mm,
So it is really important. Without maths, we can't make good, genuine decisions. And I think this is kind of goes back to what I said earlier. And the way that I like to think about, although I think we might have already established that point, but I don't know whether you're aware of Plato's cave metaphor, but Plato made this metaphor about reality in his case, but I think it applies more to this discussion than reality in general. But the idea was that you have a prisoner in a cave, and behind the prisoner there's a fire, and the only thing that the prisoner can see is a shadow, so his own shadow and the shadow of the movement between him and the fire. And that kind of is a distorted version of reality, but it's the best that the prisoner has, right? But it's
mm,
important to recognize that it's distorted, but at the same time, you don't want to ignore the fact that the shadows aren't reality. I look at maths and numbers and quantitative approaches as very much that. As long as we appreciate the fact that it's always a distorted version of reality, and as long as we have the humility to kind of appreciate that there are no perfect metrics, there are no perfect proxies, both in research and in practice. And the reality is that everything is so complex, yet most of the metrics and methods we use aren't necessarily all that sophisticated. And for good reason. There's another
mm,
discussion around you don't want to overcomplicate things because that just takes you away from the whole point of
mm,
having maths. So yes, I would put it at 40% just to highlight the fact that it has to be less than 50%. We have to appreciate that, there's the narrative. Um, around reality is the most important. There's
Mm.
underlying trade-offs and tensions that we have to understand. We have to define value. We have to appreciate all the vast array of factors that influence the reality of decisions we're making. And then within that, we try to kind of put some grounding and structure through maths. And we're always asking ourselves, well, what are the limitations of what we know? And that kind of approach, I think, is really beneficial because it tells us what we don't know. And as long as we understand all the things that we're not picking up, or at least the limits of what we are picking up, that's probably more correct. I think using mathematical tools is great. The issue becomes in a field like finance, which is very quantitative, where you can just focus on the numbers, on the metrics, and almost forget that that's not the end state and try to optimize for that because it's easy to optimize for it. Like maths gives you that internal consistency, maths gives you that sense of certainty, and it's almost
Yes.
a false sense of precision. Um, but the world in reality isn't as precise. So we kind of just have to remind ourselves what we don't know. And I think that's just final point. I think that's the beauty of academia, but I also think that's kind of the main lesson that I always hope our students take from the degree. We try to bring them to the frontiers of knowledge,
Mm.
not because the frontiers of knowledge give them all the answers, quite the opposite. You want to bring them to the frontiers of knowledge so that they can appreciate with confidence what tools they have at their disposal, but importantly, what else is left that we don't know, right? And I think that's the state that, any leader, but any kind of academic wants to be in, just with that healthy appreciation of all the things they don't understand and an appreciation of the tools that can help them within what we understand.
I absolutely love how you have shared that, and I'm completely paraphrasing. Money and tools, or numbers and tools, are easy to optimize. That actually, money and numbers are distorted. They are a distorted version of reality. We don't want to ignore them, but they're distorted. You talk about how investors shape executive decision making. Do you think investors and these executives understand that the numbers are a distorted view of reality?
Well, it's always hard to generalize, isn't it? So there's
Yeah.
there's a lot of different investors with different investment strategies. And depending on what they do, sometimes just focusing on the numbers might not be such a bad strategy. So Renaissance Technologies, kind of the hedge fund that has been for the last 30, 40 years making 60% returns year on year. Well, they actually just follow a mathematical model. Now, they effectively exploit market microstructure dynamics. They're kind of good at picking up the signal from the noise. And really, what they do is purely a mathematical problem. And they, through skill and a whole host of other proprietary things, they actually are able to exploit maths in order to generate, identify all the mispricing in the market, or short-term kind of
Yeah,
millisecond
yeah.
mispricing in the market, etc. So I don't want to dispel kind of maths as not being important because clearly that's an example where 100% maths generates really good outcomes.
Yes.
But your broader question, I think, holds. And again, it's hard. I really don't want to put like psychoanalyze investors. What I can say is that the reality is that the value, certainly from an investment perspective, everyone's making a bet about the
Mm.
value of a company, right? The example I give our students to kind of illustrate the power of narratives and how
Yes.
maths is just a tool, is a valuation of Tesla, right? So you can kind of work through a number of narratives. You can value Tesla as a luxury automaker, right? In which case the price is around $30, right? So you kind of make a few assumptions. You use the numbers very much to kind of to make assumptions about future growth. So you can kind of use numbers to define, well, is Tesla a growth company or is it a mature company? And you can, really quantify all of the assumptions. But the assumptions at the end of the day are based on a narrative, and you use numbers to kind of validate that narrative. And you kind of
Mm,
go on and on and on. And as you kind of, your narrative becomes more expansive, right? So you say, well, Tesla isn't really an automaker, but Tesla is almost like a venture capital firm that's investing in the technologies of the future. And those technologies will disrupt the market, and Tesla will have 100% share of those markets in the future. Then you kind of get closer to where the actual price is. And it just shows how it's not the numbers that actually define the market price.
mm,
It actually, there's a narrative, and clearly investors have a certain narrative. Now, whether they know it or not, whether, your retail investor, for example, goes through the whole process of pinning down a narrative and working through the numbers, or whether they kind of see a price and they kind of think, I believe in this and I'm
mm.
going to make a bet on it. It's kind of separate, into how institutional investors and different forms of institutional investors make those decisions. Again, it's not for me
Yeah.
to decide, and I don't have any inside knowledge on it. But the point is, again, the actual kind of outcomes we see are the result of a narrative
Yes.
as opposed to numbers.
And just so I understand the 60-40 ratio, the narrative and the reality being on the people's side, the math, the 40% being, or the 40 being the mathematical representation of that reality and the narrative.
Yeah, that's how I see it. That's actually a really, really nice way of Yeah, that's exactly it.
I definitely fell into finance by accident. A little, like you said with your career, you sort of just do the things as you're supposed to do back then. I think this generation's a little more intentional and smarter, which I'm hopeful about. Um, but I think had I heard what you said, I might have chosen to go into finance because that's what I think is fascinating. I think I'm fascinated by people, I'm fascinated by business, I'm fascinated by and frustrated by the world. Uh, and that is all fascinating. And numbers as a representation of that for the purposes of decision making, for simplicity, for trade, for us being able to have, for people that live in different countries and speak different verbal word
Mm.
languages to be able to speak the same money language, like it's very helpful in that respect. Yeah, I might have chosen to do finance back then.
Well, finance, and you should have, because what I tell all of our students is finance really does make the world go round, right? So at the end of the day, the outcomes we see are very much shaped by finance, because when you think about it, there's a funding element. So where money
Mm,
goes
yeah,
shapes what happens. And this is kind of the part that I'm really passionate about in terms of innovation, right? So what we're actually seeing, and I know there's a lot of hype about innovation, artificial intelligence, etc. And there's almost this um, perception that we're living in, exponentially, in times of exponential technological growth. But when you really look in the data, when you quantify the concept of innovation, so as an example, you use some of those natural language processing techniques to see how radical are new patents, how radical is new science. You actually see that around the years 2000, so the turn of the century, there's a plateauing of
Mm,
breakthrough, radical forms of innovation. So we're really good in incremental innovation. We do a lot there where we have existing paradigms,
yes,
technological and broader kind of innovative paradigms. And we're very good at incrementally innovating and growing those clusters. But we're actually much worse than we were in the past, especially the 90s and the 80s, in terms of creating entirely new paradigms that are so important for productivity growth. Now, that's
mm,
important because, A, on its own, it is the source of a lot of problems. Without constant kind of breakthrough forms of innovation, we're not going to see productivity growth. And we haven't, right? So the years to, the turn of the century is kind of when we also peaked in terms of productivity growth. Since then,
mm,
productivity growth has been declining, and over the last few years, it's been getting worse and worse.
mm.
So it is a real problem. But, at the core of it is finance. So the question is, well, is finance and are financial markets, are investors supporting, the most radical forms of innovation? And probably the answer is no, but there's also an element of governance, how governance is shaping not only direct influence on leaders and the decisions they make, but also then how it trickles down into the culture, how it shapes, even from the small to the big decisions within
Mm,
organizations. And we can go, down that kind of, the trickle down effect. But the
mm,
reality is that, and this is kind of the tension I also alluded to before. There is this tension where as we create systems that are more optimized towards efficiency, performance, especially short-term performance, all the
mm,
things that investors want. At the same time, we're kind of the flip side of it is we're progressively becoming less open to embracing uncertainty, to certain elements that are
mhm.
wasteful, and innovation tends to be wasteful, right? Because for one breakthrough idea, you need 10, a
Yes.
100 even maybe, right? So and no one really wants to be the one, and so there's very little tolerance for failure. But the question is why, right? Where does kind
Mm,
of that culture come from? And
yes.
it's a hard question to answer, one that I can't answer definitively, but you definitely can say that financial markets, the push towards better governance, push towards greater certainty, push towards more quantitative approaches to dealing with risk, try to quantify everything, including performance metrics within how employees kind of
Mm,
operate and how we measure their own performance. Again, even at universities, that is a challenge because a lot of the most breakthrough ideas, by definition, they are supposed to deviate from what we define. Right. Once you
yes.
define something and you want to optimize what you've defined, you're kind of optimizing within an established cluster, right? To do anything different, anything that's truly radically innovative, you're kind of deviating from that. Um, and again, what's the solution? I actually don't know. It's a fascinating area, but one where it just goes to show how influential finance is
Mm,
outside of the things that we actually very often think when we
yes.
think about finance and the implications it has and what it does and how it works.
If you were to be able to take a look inside my brain right now, it would look like spaghetti because there are so many
Sorry.
neural
No, that's
pathways trying to connect and questions and scenarios and stories. And I think I think that's your whole point, right? And certainly, those in business don't have the luxury to get tied up in knots about this stuff, right? But I guess that's the blessing and the curse of being in research is you can sit in that conceptual space and ask all of those what if questions and to identify. I mean, that's just such an interesting insight you've drawn out that in this context where we want productivity, efficiency, certainty,
there's
innovation,
always a cost, right? So there's
innovation
always a trade-off.
requires waste. Like
Exactly.
how so and then it's how do those things coexist next to each other? And yeah, I mean, I'm glad you said you don't know the answer because my mind is blown. I've got no idea. But that's a real tension when we say we need, because currently we're in a bit of a productivity crisis here in Australia, but at the same time we're pretty slow on innovation too. So how do you grow the two if
The problem is bigger. So it's not even just an Australian problem, right? So when I talk about some of the slowdown in radical breakthrough innovation, that's kind of at the frontier. So that's looking at the
yeah, right.
global trends, not just Australian. Look, to a large extent, I think the problem though is that, and this goes back to now the power of maths, right? So we talked about all the reasons you wouldn't want to focus entirely on metrics, maths, etc.
Yeah.
But the problem with innovation is that it's very hard to quantify. And
Mm,
therefore, because it's hard to quantify at the individual and even aggregate level, it's very easy for it to become invisible. So it becomes an externality, right? So for a lot of decision makers, That goes for companies, that goes for all types of organizations, governments, but also just society, individual people. You see the things that you can quantify. You see the efficiencies that you can gain, the performance metrics, the stock returns, etc., those narratives about
Mm,
the future. You can kind of see the things you quantify. It's very hard to measure and quantify innovation. A part of what at RMIT we do in like in the department in the finance and frontier innovation cluster is we try to quantify it. But I think it's really important because unless and until you quantify it effectively, you can't start having a conversation with business leaders. And as long as it's not visible and it's not on the radar, it's hard even conceptually for optimize for all the things that we've been optimizing, for the last number of decades, but also factor in innovation and especially, and again, innovation could mean something different to everyone. That's the other
yeah,
problem, but especially when you think about those productivity enhancing radical forms of innovation.
yeah.
And I actually think that's important that we have that as part of the conversation because we've almost, I feel, at a cultural level, we've squeezed out the acceptance for people to for a degree of conceptual conflict within organizations trying to do
Yes.
things differently. And
Yeah.
the reason is, a lot of those things, like not conflict per se, but just disagreement, debates, genuine kind of debates about
Yes.
how to do things, acceptance for failure, etc. All of that, obviously has been kind of weeded out, or to a large extent, that's optimal because there's efficiency gains of people kind
Mm,
of communicating faster, more frictionlessly, etc. But
mm,
again, we're kind of not appreciating the hidden trade-offs. And, if that's kind of really the point. Like I said at the
mm.
start, the reason we like quantitative approaches is they allow us to work through the underlying trade-offs. And if we don't, and that's why we need to quantify the different factors and forces at play. And therefore, there is a true value in trying to quantify as broadly and as many things as possible, as long as we remember that's just a proxy. And as long as we remember there's always something we're missing.
Correct.
I think that's good.
And so, yes, and I think that's such a good point because, we're not pro or against math here. We're not pro or against innovation. Like, we want to have an inclusive conversation because that's the exciting part of it. You can't measure what doesn't exist, right? And because by
Exactly.
definition, innovation doesn't exist, that's the challenge. So we just keep ignoring it, putting it to the side, optimizing what we can measure and does exist. And we'll just keep forgetting because we're so busy and all the rest of it.
And
Yeah.
I would just add, in terms of even that conceptual framing of innovation, when you put it in kind of more statistical, mathematical forms, and you look at a bell-shaped distribution of outcomes,
Mm.
very often we think about putting in place structures that increase the mean, right? So that's kind of
Yes.
what generally we try to do. Now, the problem with innovation is we're trying to optimize for the right tailed outcome.
Ooh.
So those positive, really
Yes.
extreme positive outcomes, that's actually innovation. The median, like in innovation, you're not after the median outcome. That's not
No.
innovative. You're after the right tailed
Yes.
outcome. And that's a problem, like generally from a risk management perspective, the tools that we use to manage risk, it's well, there's different tools. So, like, I don't want to be too, prescriptive. But one thing is you want to reduce the variance, so you want to increase the mean while reducing the variance. That's kind of a perfect outcome.
Mm-hmm.
Another one is you want to reduce the tails, so the frequency of those extreme outcomes.
Yes.
And through a whole host of means, you're actually trying to reduce the range of outcomes because that range
That's
is
right.
defined as bad. That's part of risk
Yes.
management. But when it comes to innovation, it's quite the opposite. You actually want to increase those, that you want to manage the
Yeah.
left side, the bad outcomes, and there's going to be plenty of those. So you want to make sure that you have a system in place that ensures that you can ride those out and you can manage those and those don't become too problematic. But you
Mm.
want those extreme kind of outlier outcomes to happen more frequently. Whereas again, that's kind of, so I think that's an important part of how we define innovation as well. It's
This
antithetical to what we generally try to
correct.
optimize.
And so here's my sort of final question for us to explore, which is around how do you design the mechanisms and structures inside business so that you create value and maximize your chance to truly innovate?
Yeah. Well, I think, obviously that's a really hard question and one that I don't have a definitive answer for. And that actually is at the core. Like, I don't think we'll
That's
ever
exactly
have a
right.
definitive answer because there is some kind of really complex trade off. And once we start optimizing for innovation while being aware of all the other kind of performance and short term metrics that we're aware of, there's going to be a third order issue that, like even spiritual kind of element that might, we're so invested, our minds are so invested into trying to come up with novel and new things, and all of our creative energy is going into, the
Yes.
economic sphere, that we then realize, oh dear, that actually there's been a trade-off that we haven't thought about. Now, so that's kind of the general point. More specifically, there are certain things that I think we know, and we've talked about a lot of those. So I think leaders kind of embracing uncertainty is important, right? So a slightly different approach to uncertainty and not always viewing uncertainty just from the perspective of managing bad outcomes, right? So when we
Mm,
think about variance, when we think about, standard deviations, we have some sort of factors and forces that influence outcomes, and all of them have a standard deviation.
mm,
And we view that as a bad thing, right? Because that kind of
yeah.
increases the likelihood of negative outcomes. So I think
Mm,
just a cultural shift there. Um, we can go like there's a big chunk. Obviously, innovation doesn't occur, and it never does. Certainly, the radical forms of innovation never happen at the top tiers of an organization, nor do they happen at the top tiers of the government, right? But I think we have a general culture in place where we like to engineer outcomes. And
mm,
innovation outcomes are just so hard to engineer. And very, it's just kind of, this is an argument that very much applies in political sciences as well. But very often the leadership class is like an entrenched elite in the sense that they don't
mm,
necessarily want things at lower levels of the organization to start happening in ways that they haven't envisaged, or ways that they haven't engineered in place, because it almost kind of feels like they're losing control.
yeah.
Yet once you kind of control is great, again, from an efficiency perspective. And this is kind of the kind of whole political economy argument where you can have countries which are very much top down managed, and they are amazing in terms of scaling up, scaling up existing technologies, and being more productive and efficient within those clusters, but being quite poor in terms of allowing for disruptive new types, those exploratory radical forms of innovation. So I think that's the other one. But there are elements here that fall beyond leaders. So you have investors. Again, there is a tension, and we don't really know the degree to which shareholders or investors shape outcomes, and where kind of leaders
Mm,
step in. It's kind of very context dependent, but clearly that's an important element. And I think
yes.
until investors recognize the longer term importance of innovation and
Mm,
of allowing firms to actually not only optimize short term returns. That's important. There is also just a societal, even as individuals. I think a lot of us individually make decisions that are safe, that are good for our careers. And when you look at the most outstanding, like the mRNA um, technology, so the science, the lady that developed the mRNA technology, at the University of Pennsylvania, she actually went through a really difficult process. So she got demoted at the University of Pennsylvania. She couldn't get any funding for 20 years. et cetera, et cetera. And she was really pursuing that idea in spite of really bad career outcomes and also lack of any recognition and support.
Hmm.
That's true for the pre-2012 kind of AI developers, right? So a lot of those were kind of, that was the wrong career path to go on, and the decisions to kind of continue on that trajectory was detrimental to them. But I think most of us kind of prefer to make those decisions where we get quick rewards. Yet we like to then pass a buck on someone else and say, well, the government isn't doing enough, or our
Yes.
leaders aren't doing enough, or the investors aren't doing enough. And the final thing I'll say, because it's a paper I read recently, and I just found it fascinating because it just illustrated the point to me so well. Um, and it's about the American alcohol prohibition in 1920. And you might be wondering, well, how is that
Yeah.
relevant? But what a recent paper by I think it's Michael Andrews, a kind of really good economist in the US. But what he found is that following the American alcohol prohibition, there was a over 20% reduction in patenting over the next 2 years. So it's really a first order. One of the main economic consequences of that policy was a decline in innovation. Yet no one, up until that paper, no one would say, well, that was, the prohibition was bad because it destroyed innovation and it took many years to then go back to those levels. And at the time when the prohibition was debated, economists were one of the parties that were most in favor of the prohibition, because in their minds it's going
Mm.
to drive efficiency, drive productivity, it's going to take down worker absenteeism, it's
Yes.
going to reduce workplace incidents, so when in the American Economic Association meeting in 1919, they wanted to do a debate on the prohibition. They couldn't find any economists that wanted to take the stance of arguing against the prohibition because they thought it's going to be obviously such a good thing.
Yes.
And I think that just highlights
Huh.
how innovation, generally speaking, it tends to be that unintended consequence. Like when we try to optimize it, well, then we're only operating within established paradigms. So we say, well, AI
Mm.
is great, let's invest in AI. Like a few years ago, it was VR is great. The future is going to
Yeah.
be VR. Let's invest in VR, right? We only look at what we know, but that's not innovation, right? That's
Mm.
kind of the exact opposite. But that's
Yes.
trying to drive kind of efficiencies, etc. When it comes to true innovation, it always is going to be you can't engineer it because if anything, very often innovation is more of a unintended consequence of all the other things that we do because of all the other things we can think of. So I don't know what kind of we need to do, but I think just that humility actually is really
Mm.
important. That there always is an unintended consequence in a policy we pursue. And how that helps drive outcomes, I don't know. But I
Mm.
think it's a good starting point to making better decisions, right? Because almost, by construction, we're going to have unintended consequences of whatever we do. And if we just gravitate to what we know and what we
What we know.
understand,
Yeah.
um, we're probably more likely to miss the unintended consequences. And if we're at least a little bit humble about what those outcomes might be.
I got to say, when you were telling that story about prohibition, I thought the obvious conclusion was drink alcohol, open up the creative brain, create innovation. I thought that's where you were going with that. But
Well, actually, just so I don't leave you on, because that's actually important. The channel was an alcohol. Just I actually didn't mention it. The channel was an alcohol. So in the US, the saloon was the main place that brought together. What was the saloon? The alcohol
ah,
saloon was a place where
huh.
social interaction happened. So that's the way. If you were an inventor, that's where you would have met
Yes.
your investor, right?
Yes.
That's where your engineers would kind of think about ideas and exchange and debate topics. So that was a place, that was the medium of exchange of information. And because the saloon was, at least for the first 2 or 3 years of the
Yes.
policy, was the main, saloons were effectively shut.
Yeah.
There was no, alternative ways of information actually, being transferred, so there was this decline in innovation. No, there might be an alcohol element to it as well, I don't know, but just just to
Or it
keep
might be the fact we're recording on a Friday afternoon. I'm not sure.
but if you ever need an excuse, you just remember that tape.
It's economics. I must do it. But you know what's really interesting about that? I'm so pleased that I was a little bit cheeky and you corrected me, because we've come full circle to this idea that blew my mind at the beginning, which is finance as a social science. Um, there are so many things that I have learned today, Edward. I'm so grateful. I will never look at a bell curve again, because I will now intentionally go for the little corners, not the middle. And I think and look, what you have done today, and I'm so grateful, is brought the real context to things that are really complicated for the layperson. You've brought them to life. And I think this was my missing link back in my university days. I think about all of the CFOs I work with, and what they're trying to do is improve financial acumen and commercial awareness around their business. If they can simplify and talk to the narrative like you have today, I think that's going to go a long way. But yeah, I'll never look at I'll never look at a bell curve the same again. That prohibition story, I love that. We've not for the alcohol, but for the place of social connection to drive innovation. Because again, you think about all the conversations we hear about collaboration and diversity and all of those things. Well, that was what was happening in the saloon that didn't happen in the saloon in that time, right?
Yeah, well, and I think that's the importance also of what you're doing, Elena. It's kind of actually trying to bring different perspectives. One
Ah,
of the things that I notice where that's an unfortunate part of today's society, partially because it's so complicated, maybe, is
mm,
how siloed it is. So we academics, we talk to other academics. CFOs talk to other CFOs. Your engineers are going to talk to other engineers, and there's just so little opportunities for those different segments and ideas and perspectives to intersect, interact, and
mm.
we can kind of learn from one another. That was kind of what the saloon did.
Yeah,
So maybe bring
absolutely.
back the saloons.
Oh, maybe we need to rebadge the podcast "The Saloon." And then, as the last thing that I will that I will call out, because I think we this has been a very whilst you've simplified it beautifully, you've simplified the theory and the concepts beautifully. It's been quite a complex conversation, because the problem is complex. But I want to draw it back to the example that you gave us, that Renaissance
Technologies.
is a successful business because it makes the choice to base investment decisions on 100% math. And
Mm.
I think this is the core through all of the complexity. What makes it complex is we are talking about a society of individual humans who are all making individually disparate and individually driven decisions. And so to bring those together in a coherent way is really hard.
Mm.
And I think that's what makes finance hard. And that's the underlying myth of money, is that it's money, it's one thing, but it actually is designed to be a simple tool to represent so many disparate interests. So I think that idea of intentionality, that's why I like that example, because Renaissance has been intentional. We are going to make it an
Mm.
investment decision purely on the maths. We're all allowed to make our own financial decisions the way we want, with intention. And I guess it's that melting pot of intentions that make conversations and businesses complex.
Absolutely. Absolutely. Couldn't
And
agree
how
more.
cool is that?
Very.
Edward, thank you so much. This has been such an enlightening conversation. How do I learn more from you? How, if I was listening to this and really wanted to get inside your brain more, learn more from you, what would be the best way for people to reach you?
Well, funnily enough, I'm not very active on the social media, so that's a
Said
conscious
like a
choice I
professor.
made, and I do prefer to go in depth, like I said. Look, I do have a university kind of webpage, but yeah, just feel free to kind of reach out to me. I'm kind of, for anyone kind of in the Melbourne area, I'm kind of always happy to grab a coffee. Reply to any email. Just, I think email is old school, but sometimes the best way to communicate.
It is, it is. And how would I find your email address? Or what is your email
So, well,
address?
it's edward.podolsky@rmit.edu.au, or you can just Google me and you'll find my kind of university webpage and it'll be there.
Wonderful. Edward, this has been so great. Thank you so much for being so generous in your sharing in a really simple way and the examples that you've used to bring it to life. It's been really powerful.
Thank you very much. I really enjoyed it, Alena.
Good stuff. Thank you. What a great chat with Edward. And this leads us right into our listener question. And remember, if you want to submit a listener question, you can email us at realmathofbusiness@gmail.com, or you can leave a comment on YouTube or Spotify and we'll hopefully get it into a future episode. This week's listener question for this episode is from Amy. Hi, Alena. Really enjoyed the chats. I just wanted to know what ways leaders can build trust with their employees. You were chatting about it a bit with Dane, but I wanted to hear if you had any ideas from your own experience. Best, Amy. Great question. And I'm going to answer it really simply because I find trust is one of those kind of esoteric concepts or ideas where it feels hard to develop or feels hard to build, but super simple to destroy it or know that it's not there. It's really evident. I think leaders simply need to build trust with their employees by doing what they say they're going to do. It's really as simple as that. You know, as I've been writing my book, The Real Math of Business, one of the symptoms of poor math in business that manifests itself in people is mistrust. And how does that manifest itself? Well, you know, I think we've all seen, experienced, or been the leaders that come out of a strategic planning offsite and go, "We've got this great new strategy. We wave the PowerPoint deck around. We do the great town hall. We're going to do this. We're going to do this. We're going to do this." And then there's crickets. The PowerPoint pack goes in the drawer. The strategy gets shelved. And we just keep fighting fires. We don't actually deliver on the promises that we make. So, how do you build trust with your employees? Just do what you say you're going to do. And I reckon it's as simple as that. Amy, I intentionally have kept this short. I hope that helps and serves as a reminder because that concept, that idea, that prompt is not new. Thank you for listening to The Real Math of Business with Alena Bennett. If you liked this episode, remember to subscribe for more content and stay on top of the real math of business. I've been Alena Bennett. Thank you for listening.